Thanks for joining us for today's Fireside Chat. We're delighted to have Jeff Green, who's a founder, chairman, and CEO of The Trade Desk, and Doug Knopper, who we'll introduce in a moment as well. Thanks everyone for joining us. We've had a few hundred people that have registered for this Fireside Chat. So we're certainly excited to speak to Jeff Green, founder, chairman, and CEO of The Trade Desk, and hear about his story all the way from the founding of The Trade Desk through to IPO to where we are today. So let's begin here with today's Fireside Chat. We have about an hour set aside from 1 o'clock to 2 o'clock Eastern, first 50 minutes or so, which will be an interview and discussion with Jeff Green, and the last 10 minutes that will be with Doug Knopper. So we'll begin here by introducing both Doug Knopper and Jeff Green. Doug Knopper, who will be co-moderating with me today, as many of you know, is a co-founder and former co-CEO of FreeWheel, which was a video and advertising technology supply-side platform that was acquired by Comcast for $375 million. And more recently, Doug is a board member of Magnite, which is the merger of Teleria and Rubicon, and the leading supply-side platform, as well as other ventures that Doug is advising on at the board and other levels. So Doug, thanks for joining us and co-moderating with me today.
Michael.
And of course, Jeff Green, who's our featured guest for today's Fireside Chat, the founder, chairman, and CEO of The Trade Desk. As most of you know, The Trade Desk is the fastest growing demand-side advertising technology platform. It's exclusively focused on the buy side and helping brands. And it is the best-in-class technology to manage display, social, mobile, and video advertising campaigns and all other digital channels, which we'll get into today. To begin with an overview, we'll share some highlights of The Trade Desk. It was founded in 2009, so we're into about 11 years now. And as you know, founded by Jeff Green. The market cap hovers around $20 billion or so. And the last 12 months of the trailing 12 months net revenue is about $680 million as of June 30th or Q2 of this year. The net income is about $120 million, again, for the last 12 months, as of June 30th of this year, which implies a net income margin of close to 18%, certainly a phenomenal achievement for any ad tech platform, particularly one of this scale. The Trade Desk operates in 23 offices across 4 continents. It's headquartered in Ventura, California, and employs about 1,500 full-time FTEs, full-time employees. In the last 5 years, its CAGR has exceeded 70%. So that's its net revenue CAGR from 2014 through the end of last year. And the gross spend for last year exceeded $3 billion of gross ad spend traded through the Trade Desk. So with that, we'll now begin with the agenda. And well, first, I'll have a brief overview of Madison Alley. And as you know, Madison Alley is a strategic M&A and capital advisory group exclusively focused on digital marketing, media and advertising, technology, data and services, as well as commerce. We're based in New York City with a significant presence in Silicon Valley and also San Diego. We're typically raising capital between $10 to $150 million, with M&A transactions between $25 million and $250 million. One of our distinctions is that we're led by world-class digital industry CEOs and corporate development executives from the buy side. So we have a great deal of strategic global insight from the buy side and from a strategic insight into how to ultimately develop and realize premium value for companies in this space. So with that, let's now begin with the agenda. We'll be talking through 5 main topics here today. First, allow Jeff Green to, in his own words, describe The Trade Desk. And then we'll hear more about the story of The Trade Desk all the way from startup to IPO, which has been a remarkable success. Then hear about the company from its date of IPO to today, as it's continued to exceed and has been a phenomenal growth accomplishment, in the years since it's been public. And then hear from Jeff about leadership in a crisis, particularly in this year, 2020, given the challenges that many companies have faced. And finally, hear about the future of programmatic advertising, where we are today and where advertising technology is going, followed by some Q&A for about 10 minutes. So let us begin, and Doug, if you'd like to begin to get us started.
Yep. Thanks, Michael. And hi, Jeff. Nice to see you again.
Hi.
I'm going to start with a softball and make it easy for you, Jeff. Tell me in your own words, what is the trade desk? What the hell do you do? And do it in words that your mom will understand.
All right. Well, this is where I don't think it's a softball, just because I've been trying to help friends and family understand this for the last 10 or 20 years. And I never feel satisfied with how I've answered. So in the simplest way, or at least the way I'm trying to do it now, if you want to buy ads from Facebook on the internet, you go to Facebook. If you want to buy ads from Google or on YouTube, you go to Google. If you want to buy ads on the rest of the internet, you come to us. And we're basically providing access to everything else. And when you put all that together, we represent an alternative to Google and Facebook that has data-driven choices the same way that they do, but with our interests more aligned with advertisers so that they know what they're getting and they can trust us a little bit more than they can the big companies. So that's what we're after. And our business has really taken off since connected TV has become such a huge phenomenon. And it was something that we said from the beginning, everything we do at this point is a dress rehearsal for connected TV. So sometimes people think of ads on the internet, they think of the banners, and that is part of our business, but it's only about 20%. It's also your phone, your iPad, basically anything connected to the internet.
Yep. And is that what the vision has always been? Is that how you started? I mean, we'll talk about kind of the path in a minute, but is that the vision you laid out when you started the company?
Yeah. When we first started, we were trying to basically create some guiding principles. And one of the things that I always worry about whenever a business is getting started, I'm sure this is relevant to most of the people listening. When you're creating a business, you're going to have anxiety on one side or the other of this continuum. One is you're too small and you're afraid you're going to be a feature on somebody else's platform. The other one is you're too big and you're worried you're trying to boil the ocean or tilting at windmills. Like, it's just those are the two poles that are pulling you towards it. And so I was worried that it was too big because I couldn't see people, advertisers in particular, especially big advertisers, saying, I want a mobile platform, I want a display platform, I want a video platform, I want a connected TV platform, I want an audio platform, and then to divide that up by country. So I want a German video platform and I want a Korean video platform. And when you're a big multinational corporation, which represents a significant double-digit percentage of all advertising spend, we felt like the only way to really service them was to be global and omni-channel. So from the very beginning, we said we had to do that. And for the first few years, all of my anxiety was, are we swinging for the fences? Are we boiling the ocean? Are we tilting at windmills?
And in those early days, when you were just in the original early days of planning, did you see this as the big global multinational multimedia? Like, was this your vision, or did you see it kind of a little bit more limited?
Well, so I knew that somebody would do it, and we just wanted to be in the game and sort of stay in it. I sort of envisioned us being a part of many other companies that are successful doing the same thing. And so I always pointed, because we were not the first to raise money in our space, and we didn't raise the most. Like, most of Sand Hill Road said no to us.
I've been there.
So I just wanted to be a part of the group of demand side platforms that serviced what would be a $1 trillion industry. I said back then about 10 years. Now it's 4 or 5 years away if you take normal growth curves. And so.
When you began, Jeff, you said that there were other DSPs. There are, I believe, as many as 8 other DSPs that were in the market. And it seemed that you did a very clear set of research and to understand what exactly was being done, what was successful and what was not. What is it that you learned from that, and how is it that you distinguished yourself from the beginning, having done that learning?
Yeah, so there are lots of times when your convictions are tested, and especially when you're sort of betting your career or your waking hours on it for years at a time, and go create commitments with investors and whatnot. It's just a great way to test your convictions. And so because my last business was building an exchange, and we had built some of the first real-time bidding, we basically got to look at the way everybody else bid. Mm-hmm. And what we saw in the way they bid was a glorious lack of sophistication. Like like we created this capability for you to pay a different amount for every impression on the entire internet, and you're bidding 50 cents on everything. It sort of defeats the purpose. Like, why are we doing all this if you think everything's worth 50 cents? So when we started to dig in, we saw the limitations of their technology and came to believe that they had architected it wrong. And then when we said, well, why didn't they build it right? How can that not be the focus? We also saw that they had distribution and business model problems, which was occupying all their attention. Mm-hmm. So we kind of became a rebuttal to what they were, mm-hmm. And learning from their mistakes. So we studied our competition deeply, closely, and just had a lot of conviction that there was a better way to do it, even though early on investors were like, no, this isn't.
And can you talk a little bit about some of those technological differences or other distinct differences that you set out from the beginning as you began to build it?
Yeah. So one of the things that I think has a tendency to happen is we look at success and we study success, and then we put together a playbook and we want to repeat that. And you definitely can learn a lot from other people's success, but you also have to study the failures, and you also have to look at what they've done and sort of triage what's a fluke, what's repeatable, and what's not.
Yeah.
So I felt like what everybody did is they looked at Google and bidding for media and said, well, we know what this looks like. You just copy search. And the problem with copying search is that there's some massive differences between push and pull marketing, and that in search, it's one-dimensional bidding. Refinance my mortgage, San Jose. That you buy that thing, and who's ever on the other side of that thing, they want that. They told you that. They came to you. But that's not how advertising works. They don't come to you. You go to them, and you have to win hearts and minds. And in that process, it's not one-dimensional. Is it above the fold? Is it below the fold? It's on MSN. It's a 45-year-old. It's a 7-year-old. It's like you've shown them the ad 74 times today. How much is 75 worth to you? How much was number 2 worth to you? There's just all of this variety. It's multi-dimensional. So they all architected their systems with that sort of search mindset, which tips over really fast. And so either it tips over or it lacks descriptiveness, which is why they were bidding 50 cents over and over and over again. So we looked at it and said, okay, let's figure out, given the differences, let's architect this totally differently. And so we almost started with anything's possible except for the way they architected Google AdWords. Like, you just can't do it that way. So we sort of started with, again, a rebuttal to what was there instead of trying to copy the playbook, which was one of the mistakes of our competitors.
So Jeff, I want to shift a little bit to the IPO. And at what point, so you've now got your path, you're moving along, you're starting to be successful. When did you guys wake up and go, you know what, this is a company that can IPO? And what did you do at that point, and what was your path to get there? You had a little bit of a different and non-traditional path than other companies. Yeah.
So first we raced to profitability. So, that's very different than I think most companies in Silicon Valley. There's this mindset of like, well, raise it when you can, because you never know what you're going to need. And I just believe that mindset would be really detrimental. Now, we understood the financial mechanics or the engine that we had, and we understood that if you can get to a certain degree of operating leverage, that everything falls to the bottom line and that it's a super healthy business. Not all businesses are that way. Different business models require something else. If I were running Spotify's business or Uber's business, I would raise as much capital as possible. That's the only way to win. But in our case, we felt like we could do it we just needed to get to profitable, and then let's reinvest every single dollar. And that made it so we felt like we had our fate in our own hands, which was really important because that gave us objectivity when people kept knocking on the door for M&A. And so when people knocked on the door for M&A, a lot of entrepreneurs just want a reasonable exit so that they can make a few $1 million or $10 million or whatever their number is. But that isn't what motivated us. We really wanted to change it. And so every time somebody knocked on the door, we said, convince me you're not going to screw up my company. That was the first question. Convince me you're not going to screw it up. And sometimes when they were big, and I'm not saying that we had detailed conversations, but Yahoo or Microsoft, you have a long history of screwing up companies. Like the fact that you're big that's not appealing. That isn't a feature. That's a bug as far as I'm concerned, because this is about agility and I don't want you to screw up our business. So convince us you're not going to. So after going through that 5 to 10 times, you stop believing that there's anybody out there that can help you get to the next level. And then of course, investors start to get a little bit antsy, or at least some of them do, because they realize the value that have been created. And they also realize that they would be in the VC Hall of Fame if you just exit. So they start to push a little bit to exit. And so IPO becomes an important thing to consider. People think of an IPO as an exit. It is for your investors, but it is not for the people running the business. And so that once again required just a lot of soul searching, which is, do we really believe that we're right and that we can compete with Google and Facebook? And if we don't believe this is over $100 billion business, then we shouldn't do this. We should sell to one of them, sell to one of the other companies that's already big, and take the risk that comes with them ruining it, and let's try to protect it that way. But what do we really believe about it? And that was actually the hardest decision that I think I've made in at least trade desk history, simply because
the decision to be on an IPO path. Yeah,
to go public, because I knew that I could make 100 millionaires plus by just selling the company at that point. We by all measures, it would have been a success. And are we right about just the future? And can we really compete? And there's the voice in your head saying, are you crazy? You think you can compete with Google and Facebook? Like, look at their resources, look at what they do. And I had to really parse out that I'm not trying to compete with Google in the sense that I'm not building a search engine. We're not building self-driving cars. We've not laid fiber in the Pacific Ocean. We're just trying to compete with the 47th highest priority division of Google, which is their DSP. And because we care more and are more objective, we can do it. And because connected TV is not monopolizable, if that's a word, it's not, but it should be. We said, let's press on. And there was one other hurdle to get there, which is at the time, we did this NDR, non-deal roadshow, which if anybody's ever considering going public, you have to do it. You learn so much on that. But we walked into a meeting and the guy's like, hey, who are you guys and what do you do? And as soon as I explained what we did, he just got really pissed off and said, who set this meeting up? Who did you lie to get the meeting? He was basically implying that we had lied to get his time, because he said I would never take an ad tech meeting. And I said, hear me out, because I know that we're it's probably us and mining that are the most hated industries in the world. Again, 2015, 14, and there have been zero tech IPOs. So every banker was saying, you're crazy if you want to go public. And bankers were saying to us on the buy side, what's wrong with your business? Why would you be considering doing this if there's not something wrong? So just being convinced that we could do, not just that we could compete with the 47th highest priority at Google, but we could also do what so many other companies that had tried to go public in ad tech and go up and fail and go from 2 billion to 200 million, which was basically the 10 before us had all done that. We also had to get comfortable that we could buck that trend, and that we could eventually win over Wall Street. So I'll never forget the conversation I had with the company when we told them that and told them that we were going public. And one of the things we said is, I have no confidence, zero confidence, that Wall Street will get the value of our company right on day one. And they won't see what we see. It's going to take time. And the only way that you do that with Wall Street is you do what you say over and over again. And people don't typically do that. So if we can keep our promises, then we can change the trend, change the sentiment. And that's what we signed up for that day. I did not sleep the night before that announcement.
And that was the email that you wrote to the company the night before the IPO, right?
Yeah, the night before the IPO. So I touched on it as we announced it, but it was way more clear in my mind the night before the IPO, which was I have zero doubt that they'll get it right. We priced our IPO at $18. I felt like we had undervalued the company pretty meaningfully, but I wasn't sure what Wall Street would do the next day. So when we touched 30 the next day, I knew we'd undervalued it, but it was also just feeling great about the fact that it was pretty great when you're watching the buy-sell orders, and we'd sold it to all these investors at 18, and even when the price is at 25, 26, none of them would sell. That was a great day. It was a great day.
And then sort of kind of bringing it a little bit more to today, you've had, if I'm not mistaken, you've had 44 quarters of growth and profitability. How do you do that? I mean, I think I had 44 quarters of not profitability. How did you do that?
I think it's just, I heard this interview that Mark Zuckerberg did a few years ago, or I guess it was more than a few years ago, that it just really affected me. It changed my perspective, and it was really just like a 90 seconds of the interview. And it was, I forget who was interviewing him, but they basically were saying, isn't it kind of obvious that Facebook was going to be successful? And then sort of saying, like, why didn't Microsoft or why didn't Amazon create this instead of Facebook? But when you look at what they are, it's kind of obvious, and it clearly irritated Mark. And that's the reason it was so memorable to me, is that he was just like speaking the truth, because he was irritated. And he said, no, it wasn't obvious. It's never obvious. Like, it is in hindsight. We all want to make it obvious. Like, it was obvious that Facebook was going to succeed. It wasn't. We won because we cared more than everybody else. Mm-hmm. Is almost verbatim what he said. And that, I don't know, I think that's what's happened over the last few years on with us and Wall Street. I care deeply about keeping our promises, setting expectations, and beating them.
Yeah.
I feel like I understand the concept of building trust, both with people as well as in a business context and with institutions. Yeah. And so we've just worked really hard to win trust. And there have been times where we're pushing really hard to keep our promises, because we know that trust is this really weird thing that it's like a bridge. To build the Golden Gate Bridge takes years and years and years. To burn it down can take minutes.
Right.
And so just having that in mind as we're trying to keep our promises and trying to do what we've said, it's just always focusing on what's the bottleneck. What do we have to do to get to the next level? Always being willing to make the difficult choices and never stop.
Has it become more challenging for you since you've been so consecutively exceeding expectations over, so many quarters of, that now whereas before there were very low expectations and you did a remarkable job of beating them, now the expectations are that you will exceed the bar that you set. So,
yes.
Yeah,
because what happens, of course, is they start with low, just like you said, and then you've got this big gap, and especially if you can execute well, and when you go into it knowing that you're only optimizing for value down the road, meaning that, okay, I don't care about what the price is the day we IPO, nearly as much as I do what it is 2 years from now or 5 years from now. So it's easy to say, okay, then I'm going to make sure that I keep my promises, and you have a buffer where you have some gas in the tank. But as you keep beating, the more you beat by, the more you make an analyst look bad, who then is going to have to raise that, and so the bar gets higher, and the margins of error get lower, and so managing expectations becomes more difficult.
And also because of the scale of which you have now accomplished, you now have to keep lengthening the vision for which the next milestone and plan becomes. So you've already disrupted the market. You've already are the dominant platform. Now there's a question of, what's next? Where do you
exactly go? That, I think that's a really important point. If you don't have a massive TAM, don't go public. If you don't have a lot of runway to go after growth for years and years and years, I think it's crazy to go public. Sometimes I use the example, and I don't mean to pick on anybody, but GoPro is something that had a relatively small TAM. Like, how many action cameras will a person own, and how many people need them, especially as phones get better and better. And when you think about where can they expand to? Oh, well, they'll get into the regular camera market. It's sort of like, good luck. Like, Canon and Nikon have been working on that for 100 years, and it's hard to see much inefficiency in what they do. So to me, there's not a huge TAM. It's hard to make an argument, and it's hard to see the growth going forever. In our case, we looked at connected TV. We looked at that $1 trillion TAM. We looked at 90+% of advertising is still bought without any data. We were confident that we had the size of market to go do it.
Yeah.
Jeff, I want to bring it a little bit to kind of here and now, and maybe the topic of this panel, which is leadership in a crisis. We're in 2020. We don't have to talk about all the things going on, but those of us on the West Coast, you and I specifically, we have fires to add to the pandemic, and smoke, and you can't go outside and things like that. How are you managing at this point from the company? Everybody working remote. It's been 6 months at this point. How is that impacting the company, the leadership team, the culture, morale, all that kind of stuff?
So without a doubt, and I would not be surprised if we took a toll of all the people on this call and said, where does this staff rank in most difficult years as a leader? I think most people would raise their hand and say, this is the hardest year in leadership I've ever had.
No question.
And this is by far, I can't even think of what second place looks like. And that's in part because we have done a lot over the years to create a close culture. In fact, in in February, we were all scheduled to fly all 1,500 employees to Singapore. And a part of the reason why I wanted everyone to gather, I mean, we gather once for 1 week every year. It's normally in LA, near where we're headquartered. But I wanted it to be in Singapore because of that $1 trillion pie. 2/3 of it is outside the United States, and advertising kind of follows GDP growth, and all the GDP growth in the world is coming out of Asia. So I wanted them to see the future of our company and to paint a picture for where we're going. So I was so excited. It took us 2 years to plan, and I was reluctant to cancel. It took me a while to just accept that it was not prudent for us to go there. So here we'd had this plan to bring everybody together, and then it felt like from the moment we made that decision in late January, we fast forward 45 days and we go from having 25 offices to having 1,600 offices with every person working from home. It's managing everybody's mental health, managing focus. We're a very collaborative company, like figuring out how to do that remotely, and just sending a Zoom link does not compensate for everything, as we all know. Yeah. I didn't know I would detest Zoom as much as I do at this point. As much as I'm grateful for it on one hand, just also the 70% of communications nonverbal, without eye contact, without body language, like just so much is lost. And then isolation, people worried about their health. We do business in countries where there's not great medical care. So massive disparities there. Governments around the world having very different positions. Managing all of that has been really difficult. But it also has reminded me of this is a moment we're sort of cashing in on all the culture we built for the last decade. It's been really great to see sort of taking withdrawals. It's sort of like a 401k where it's a cultural 401k where you're making deposits every month for a decade. You don't know when you'll need it, and then something like COVID, which nobody saw coming, happens, and then you start withdrawing from that 401k and seeing the benefits, seeing people still focused despite the fact that they're remote, and that we care more and we're more focused. When our competitors, it's just so much harder to do this at a company with 50,000 people and 9 million different initiatives, and it really makes it so that we can grab land during this time. So it's actually been very good for our business. I wouldn't wish this on the world. It's not worth it, if you will. I wish it weren't the case, but it's been very good for our business in every way, except for sort of the mental health of people and making certain that we're talking to that. So it's been hard.
I think it's absolutely true. And your point of kind of taking the chits out of the bank, having seen it on the flip side with Magnite, which we closed that merger between Tulare and Rubicon on March 31st.
Oh my God.
And from my perspective on the board has never met in person. So the two sides of the board, I mean, we've had 1 million Zoom calls and 1 million conference calls, but it's hard to sort of build that camaraderie and the morale. It takes a little, so you having established it, and yes, you're taking kind of chits out of the bank, but it's not depletable. So it's been interesting to watch that. Has your leadership team, how has it changed over time, and how have they risen to the occasion?
I mean, the leadership team that we've assembled it's really phenomenal. And that's where that's a part of the place where I draw just so much confidence in the future of our business. We've had to make some changes over the years, and where the person that gets you from 50 employees to 400 employees is sometimes different than the one that gets you from 400 to 1,000, or from 1,000 to 2,000, and then different levels of growth. So being okay with all of that, while at the same time, just trying to find the balance in our case between like good people who are compassionate. I think it's really easy in the current market to ignore compassion and just say, here's the expectations and I don't care how you do it, and to just focus on getting things done. It's just the opposite of our style. So finding people that have both of those things, a drive to get things done, an ability to make objective decisions while exercising compassion in execution, is something that just gives me a ton of confidence in the team. But they're really phenomenal, and we've assembled a lot of them. There's been a lot of change too, which I didn't really know this before the IPO, but I've learned since that every single company that's gone through our market cap evolution goes through the same thing, which is people make a bunch of money and then they say they want to do something else. And sometimes you have to rebuild. So sometimes you have to ask somebody to leave in order to get to the next level, even though they got you here, and you have to do that with gratitude. And other times somebody else that you don't want to leave says, hey, I just want to do something else. We've been doing this for a long time. That's okay too. So managing that process has been extremely difficult because it's just a lot of saying goodbye to people you care about, and caring is a burden. Even though it's a better way to live life, it's also a burden.
But the key that you said there is with gratitude, and I think that's missing from so many companies, and it's such an important thing.
I'd be really interested to hear, this from a psychological standpoint. You've grown so well and so fast. How much time do you and how much attention do you take to give yourself, to look back, to give yourself credit for what you've done, to rehash of what's done, and how much do you really, how do you stay focused and concentrate on continuing to innovate and keep everyone of the right mindset, put egos aside, and to innovate, given all the success that you have? How do you kind of psychologically, focus on the, how to build the next, the next generation?
Yeah, this is a great question. It's also a personal one. So I probably err on the other side, in the sense that I have this personality defect, if you will, that is, all right, like we finished the race, we grabbed the trophy. I'm not going to go stand on the podium. Let's just take the trophy and get to the next race. Like, right. I don't have time for that. Like I have to force myself to take the victory lap, if you will, because it's not in my DNA. And I think I've had to learn that from my leadership team, where I'm like, okay, we won. Now let's go to the next thing. Like, what are we going to do for the next race? And they're like, can we just take a minute? Like, what we just did was great.
Do you feel like on that note, has the company slowed? And the bigger you've gotten, do you feel like it's you don't run as many races, or the races run slower?
Not really. I feel like sometimes in our 11-year history, I'm the one driving, saying, let's go faster, we can go faster. And in fact, now is a moment, and I think it's partly because it's driven by people's anxiety of being home alone and everybody wanting to contribute and a little bit afraid of the economic environment. I have to say, especially to the senior managers, don't push too hard.
Right.
Don't push too hard. Like we can't tax the team too much.
So you're the pace car.
Yeah. So sometimes I have to say, let's slow down a little bit. We're trying on too many fronts. We're trying too hard.
Yeah.
And I feel like this is a moment where I'm mostly saying, let's slow down a little bit. Let's be deliberate. I love that everybody's going fast, but don't exhaust the team. Don't ask too much of them.
Yeah.
And those are great moments when you just get a sense of, oh wait, I don't have to motivate anybody. I just have to steer. Like I don't have to motivate anybody. that's a great, you're in a great position when that's the case, and you've got the right people around you. But sometimes I'm the gas, sometimes I'm the brakes, and right now I'm the brakes.
It would be great to segment a little bit into the current state and of course the future of advertising technology. So how has the trade desk and your business been impacted through the crisis? How has the effectiveness and how has it changed since the crisis has begun? And then we could talk more about the future in terms of connected TV and AI and those kind of things.
Yeah, so I'll touch a little bit on connected TV and the answer of how the business has changed this year. So,
sure.
We were all set to go to Singapore. We had high hopes for what we were going to lay out in vision in terms of the way that we were going to grow. And then it seems like about 5 minutes after we threw those PowerPoints in the garbage, the economy started to go like this. And everybody, big and small, was saying, how deep is this going to be? Everybody started saying how much cash we need to have on the balance sheet. I'm sure you guys lived through all of that, because there was about a 4-week period from roughly March 15th to April 15th when everybody was saying how much cash. And I'm meeting with the CFO 3 times a week saying, what do we think now? And we're all reading the tea leaves trying to figure out what that looked like. But it seemed to bottom in that very quick time as well, where people stopped panicking. It seemed like a lot of advertisers in that time said, pause everything, pause as much as we can. And programmatic really suffered because of that, because of the fact that you can't really peel back your TV budget. There's things already set in motion. It's not very agile. So that money's sort of already out in motion. But programmatic and the data-driven parts of advertising are pretty agile. So you can pause it. So we were sort of unfairly or disproportionately affected. But that same thing that is a bug on the way down is a feature on the way up, in the sense that, okay, now we're agile. Okay, now we don't know what the world holds. And the same way that I was meeting with the CFO all the time, the CMOs are often now a little more beholden to CFOs in every company around the world, where they're, people and marketing are often some of the most expensive parts of it, and people don't want to do layoffs. So controlling marketing budgets where, hey, I really want to see that this is working. I want you to believe that this is working. The only way to do that is with data. And so not only that, but COVID has this weird thing where, we pause everything, and then you have to say, oh, we're still here, we're in business, we're still selling our products. And as consumers, especially in things like CPG or even in like restaurants, we're still open. We have, there's a lot of advertising that has to be done. So during that time, we were saying to the team, we are part of the recovery. So we're in a fortunate position that we won't do any layoffs. And not only will we not do any layoffs, we need you to lead the recovery. So all of our customers are hurting. Let's go help. And so we just became sort of on a mission again. But at that exact same time, at the end of March, CTV started to skyrocket because everybody's at home. And we did this survey where we found that the number one reason people were hanging on to cable was sports. Well, sports were effectively gone. 60% of American households said that's the number one reason they hang on to cable. And then you add millions and millions of unemployment. And then what that forces, whether it's the anxiety of unemployment or unemployment, is people effectively putting together, at least mentally, the list of all the TV costs that they have. And it's like, okay, $14.95 for Netflix, $14.95 for HBO, $140 for cable. And it's that where people are like, okay, we don't even watch that anymore. We're mostly watching Netflix. And now that the Dodgers aren't on, let's just cancel. So that, and then upfronts, which happen every year, the last week of March, first week of April. So it was like the absolute worst time for broadcast television, in the sense that if you could time COVID to negatively impact television most, that's what happened. The universe
That's
conspired against broadcast television.
Yeah.
And so then people started moving things over. Disney Plus got more subscribers in the first year than Netflix got in their first 8.
Yeah.
Peacock launches in July, and just a lot of things happening so that our inventory went through the roof. And then the need for agile, more emotional advertising where you say, we care, we're here, we care about social justice. It's just been a year where advertising has sort of led the way. So it's been a perfect storm to create demand for our business.
So what does the world look like? Let's assume that the world goes somewhat back to normal in the next, 6 months, 12 months, whatever it is. Do we go back to the old ways of doing business, or have we made systemic changes in our industry and connected TV and how people watch cable? What do you think the future looks like, 2 years from now?
Yeah. So first, in terms of the way we do business, I know that there's a meaningful number of people in Silicon Valley that disagree with me on this, but I think we all want to get back to the office, and as soon as we feel like it's safe, we want that interaction. It's a better way to do business. There's just too much done that way.
Yep.
And so I do think that while I think work from home will be permanently more permissible, it will not be permanently the norm. We're just social creatures, and it's less effective, which is those two things together just make it so that I think we'll go back to offices and whatnot once we feel safe to do so. As it relates to like the changes in advertising and media landscape, I made the argument, part of the reason why I felt confident to get into the DSP race as the 9th entrant to the race, years behind and under-resourced on a relative basis, was that I believe that the move to data-driven advertising that happened in the financial crisis, which was sort of the same thing, where you cut advertising budgets, people have to really think about how I'm spending, and then they get more deliberate and more measurable, and that leads to digital and data-driven. The same thing's going to happen here. It doesn't go back from there because it's a better way to buy.
Right.
So people don't go back to being irrational or.
So is there an upfront next year?
I do think there's an upfront. Well, so if we're back to normal, I don't think we'll be back to normal enough to know. So I think there's still going to be murkiness in 2021. So I think there's going to be another week upfront. And because this year was almost non-existent, that will again put more into digital. But it's actually been a gift to traditional media companies like NBC, who's done a great job. I was talking to Linda Yaccarino yesterday. We were just talking about how we sat on a panel in January, and we were both talking about how great 2020 was going to be. It was the Olympics. It's an election year.
That must have been, early January.
And just contrast that to now. And even though, Olympics hopefully we'll have in 2021 and NBC will see an uptick from that, it did really force all the traditional companies to put more stuff online and really invest in on-demand, which they should have been doing anyway.
Right.
And so it's kind of a gift for them to catch up, because I think most of them look at it now the way I think they should, which is they're 7 years behind Netflix and they've got to catch up, and that's the future. And they've made more progress this year than they ever would have without it, even though it hurt.
I think that's one of the amazing things that's come out of here, is watching companies that probably on their own would not have made these changes. And I agree with you. It's the NBCs and the ESPNs of the world that have made substantial, quick changes that will be long lasting, will be sustainable as we go into the future. And I think you're right that Linda and NBC and companies like that will be the ones that benefit a lot from this in the future.
Yeah,
exactly.
Yeah, Jeff, you've talked a lot about connected TV, and not only today but also in other interviews. Why is it so important, and what impact is it having on your business, and that you believe it will have on advertising technology or online advertising in general? What's the significance of it, and where are we in terms of the evolution to connected TV?
So I mean, it's changing our business forever. So I think I've always believed that connected TV is the thing that will keep the open internet open. I think without connected TV, that wouldn't happen. I think it would end up in the hands of 4 or 5 what are currently called walled gardens, but it would look more like the telco space or something like that.
Yeah.
But because connected TV is not prone to monopolies the way search or social is, it will continue to be fragmented, perfectly fragmented, not too long tail like websites are, but with, at least in the English speaking world, hundreds of players creating content and hundreds of outlets. And that creates the right amount of competition. And that competition makes it so there has to be this open market, and especially because it's the most effective form, especially of top of the funnel activity. And that's where I would argue the winning of hearts and minds actually takes place, is at the top of the funnel.
You're saying because of the video and the more engaging aspect of the the connected TV, the messaging, as opposed to static display ads, there's a lot more engagement and video and interaction than otherwise.
Exactly. So, or to say it another way, what makes us all value the Mercedes-Benz brand, even if we've never driven a Mercedes-Benz before. Yeah. And it's 20 years of seeing commercials and it parked up in front of the golf course you go to, or just there's thousands and thousands of interactions with that brand. And most of them have imagery and pictures, and you think about like the emotion that evokes. It's not from 240 black and blue characters that are like, oh, now I love Mercedes.
Yeah.
So I just think that winning of hearts and minds it is most effectively done through video and audio. That has transitioned at a much faster pace in 2020. It will never go back. And because of the perfect storm, if you will, that 2020 has been as it relates to marketing and advertising, I think the open internet will stay open, especially if we all stick together on things like IDs and things that are essential to the infrastructure of the open internet.
Yeah, that's great. So we're getting close to the top of the hour here, and so we'll turn over to some Q&A. So some questions that we received, and we appreciate all the registered attendees that have submitted some questions. So I'll begin with the first one, which is probably a good one, general question. So founder and CEO Diaz Nesimoni of Jivox asks, do you see the trade desk evolving into a full marketing tech stack, creative data, owned media, social, et cetera, or remaining a DSP?
Great question, and it's great to hear from Diaz, who's a partner at Jivox. So I mean, we have to integrate it all, but you always have to figure out like what the right level of partnership. Like I like to use the analogy of operating systems. So Windows. Just said, oh, it's open market. And I would argue that they didn't do enough quality control. And so and I know this because I worked at Microsoft, and I felt like all my neighbors thought I was tech support for Microsoft. And they would come over and say, hey, you guys should really fix my printer or whatever.
You should try working at Comcast.
Yeah. Oh, yeah. That's probably even worse. But I would sometimes ask people, why do we do this? And they would say, it's not our fault. It's NVIDIA's. Our number one error is from NVIDIA, and our number 2 is from HP. It's them developing wrong. And I would often say in those conversations, the customer doesn't give a shit. They just think it's your fault. Like your brand is on it. So all they know is it doesn't work. And I remember asking an engineer in 2008, why did you buy a Mac? And he's like, because it works all the time. And that's because they partnered to get the exact right RAM, to get all the components that would work, and they put enough restrictions on the market that they focused on quality.
Yeah.
So I think of it exactly the same way, in the sense that if you do everything yourself, if you build the RAM, if they're doing that at Apple, they're in trouble. So go partner with Rambus, at least one, maybe two, maybe others, so that you can build a quality product that always works. If you make too much of a free-for-all, it's going to fail. If you do everything yourself, it's going to fail. And so figuring out what the right balance is something we do along the way. And that's why Jivix and others are important partners, because they do parts of the stack that we don't and won't. Yeah.
So let's ask you an M&A question. How much of the trade desk do you see growing organically? And to what extent do you see strategic M&A opportunities for the trade desk?
So,
in what ways?
So we have historically been really crappy at M&A. I mean, we've made one acquisition. It was a phenomenal success in that I think it's worth well over $100 million to us today. We bought it for single-digit millions just a couple of years ago. We've had one at bat and we knocked it out of the park, which sometimes can be bad because it can set a really high bar.
Yeah.
But we've always been most interested and most focused on preserving our culture. So in the same way that when somebody was trying to acquire us before we went public, we would start the discussion by saying, convince me you're not going to screw up our culture and you're not going to ruin our business. Whenever we're looking at a potential target, we kind of have to start the conversation in a similar way, which is a weird way to start a conversation. But I do think we're going to have to get better at M&A, and we will have to incorporate others as we go. But I never want to do what I think other companies in our space have really messed up on. Like, I think Yahoo is like the quintessential example of messing up on this.
Yes.
Which is their strategy at times seemed like it was, let's buy broken stuff because it's on sale. And I think that's a horrible strategy. And especially if you're in a good position, you shouldn't do that.
In any particular areas that you might consider for acquisitions or organically for that matter that you'd invest into?
Yeah, I mean, I'm still interested in finding the right DCO. I think there's only been one company that's done that well at scale, and that's Criteo. And so finding one that can scale is interesting. I think there's a ton of companies that are doing interesting things in data. I'm really interested in more companies where we would, with the company, get more data science and add to our team. Like, we're hiring as fast as you can in that field, and I think everybody's doing that. But there's just not enough supply in the world of that sort of talent.
Yeah. So we have time for just one last question here. The CEO of Outbrain has asked, as ad tech companies compete with Google and Facebook for ad dollars, would consolidation within the ad tech market help or hurt the publisher's business?
As long as it stays open internet, it's good for the business. So it's good for the open internet.
Yeah.
And what I mean by open internet, because I feel like sometimes this sort of gets lost, it is the place where price discovery is possible, where you know what you're buying and selling. Inside of most of the walled gardens, you hand over your money, you hope you get results, and they, in fact, the results are all measured by them. So there's this grading of homework, and then they can't, and they sort of hide behind privacy on this, give you fine-grained reporting so that you can actually determine what was the value of a YouTube impression versus an NBC impression. And the open internet is the place where you can compare NBC to CBS, determine efficacy, and then run a market and analysis so that real price discovery happens. That's the way great financial markets work. That's the way all capitalism works, is it's based on price discovery and at least some amount of transparency. And so as long as the consolidation happens inside of that, it will accelerate it. If it happens so that it gives more edge to sort of black box, non-price discoverable, it's bad for the market and bad for the global economy.
Well, I think that's an excellent way to, unfortunately, finalize this fireside chat on the open market platform that Trade Desk provides. So it's really been a delight having you here, Jeff, and of course you, Doug, as well, for co-moderating here. We thank all the registered attendees for joining us. This has been very enlightening, I think, on a number of fronts, but in particular, not only your success, Jeff, as founder and CEO, and learning how you were able to incubate and scale the Trade Desk through IPO into its success today, but also understanding so much about the future, where the current state of advertising technology is today and the future. So we appreciate all your insights and perspectives and taking the time today.
You bet, Michael, Doug, thank you so much.
Thanks,
Really
Michael.
appreciate it.
See you, Jeff.
Okay, take care.
Bye, everybody.